Hi guys, I'm Dan, this is Kai. We are the directors at Crescent Mortgages. It's no secret that mortgage rates have risen quite sharply in the last year, so it's quite scary times if you currently have a mortgage. So today we're going to be talking you through what to do if your mortgage scheme is ending in a market with high interest rates. Let's jump into it. So it is a scary time to have a mortgage. I mean, obviously, if you're buying, it's a bit different because you get to make that decision whether you're ready to buy a property in the current market. But if you've currently got a mortgage, you've kind of got no choice but to kind of take the hit on whatever's about to happen. So we just want to talk you through kind of what to do in this scary time, how the new mortgage rates might impact you, and some potential ways that you could reduce your mortgage payment, and just some backup plans if you really are struggling. Before we jump into it, just to remind you that we are mortgage brokers, we're not YouTubers, so we can assist you with your remortgage, we can give you free mortgage advice. So if you have any questions, just give us a call, head over to the website, leave something in the comments and we'll do our best to come back to you. So I guess to start with, just giving you an update on where things are with the current market. Now, we're not going to get into the specifics because we want this video to be relevant for a little while, and the market is changing on a kind of weekly basis. We don't know how much further rates are going to rise or if they're going to potentially come down. But I guess the main thing to highlight is that there's almost no question that if right now, if you are, any time throughout the rest of 2023, if you're coming to the end of a scheme, let's say you're coming to the end of a fixed scheme, it's almost certain that your interest rate is going to jump up, isn't it? And again, we can't give specific rates because it largely depends on how much equity you've got in the property, what type of scheme you choose. But I think a very real example would be if you're moving from a current fixed rate of 2%, which you've perhaps been on for the last couple of years, maybe longer, and you're now remortgaging to a new scheme, there's a chance that it could move up to 6%, maybe more, depending on your finer kind of details and situation. So if your rate is changing from 2% to 6%, which again is possible, depending on your mortgage term, but very roughly, your mortgage payment will increase by £220 for every £100,000 you have on your mortgage. So if you've got a £100,000 mortgage, the payment might increase by around £220, very roughly. A £200,000 mortgage, it might go up by £440, and so on. So there's no getting away. There is a big jump, especially the bigger the mortgage you have, the bigger the difference you're going to see. So quite scary, isn't it?
Yeah, I think, as Dan mentioned, this will be relevant for a while. That 2 to 6% example might not be relevant for as well, but 2 to 5, 2 to 7, 2 to 4. There are millions of people coming to the end of their remortgages in 2023, 2024, 2025. And a lot of those people will be on 1 point or 2 point something, and it's unlikely to be that low for at least a couple of years, based on various forecasts at the moment. So your rate going up is highly likely. Yeah. And I guess we're trying to minimise that as much as we can.
Yeah, and I guess that the first and maybe one of the most important bits of advice we can give you, because ultimately we can't stop your interest rate from increasing, it's just the market, it will fluctuate. But there's kind of certain things, maybe damage limitation to start with. So the first and most important thing is you will need to remortgage when you're coming to the end of your scheme. You may have done it before, or this could be your first remortgage if you only bought the property a couple of years ago and this was your first scheme, which is now ending. But the first thing is apply for the remortgage as early as possible. And the kind of maximum is normally around 6 months, isn't it? It varies from lender to lender, normally around 6 months. So if you are, some people leave it late, don't they? Some people think that you can remortgage the month before. Now, the main problem is that if you don't apply for the mortgage early, then you're going to leave yourself in a situation where when you do apply for the mortgage, just before your scheme ends, you're backed into a corner where whatever interest rates, wherever they sit at the time, that will be the rate that you're going to have to proceed with. Whereas if you apply for the mortgage 6 months early, you will lock in the interest rate upon application, which means that if interest rates continue to rise, it won't affect you. You will have locked in the rate at that point. So if you locked in a rate of 6.3%, yes, that is obviously a lot higher than what you're currently on, But if in those next 6 months between applying for the mortgage and the mortgage starting, if rates continue to rise and they get up to 7.3%, it will not impact you. You've locked in the 6.3%. So you've got the best possible rate that you could have achieved within that 6-month window. Now, I guess the benefit of that is if rates then do come down between applying for the mortgage and starting the mortgage, you can shop around for a lower rate, can't you?
Yeah, exactly. Yeah. You could move to a new lender. You can take a lower rate to the same lender, depending on the timing. But you can. The idea is, as Dan said, you lock the worst case scenario, if you will, to give yourself the best rate you could have got in those 6 months, and then hopefully they come down. And if they do, you change and you keep touching base with your broker or your bank, whoever you're talking to make sure that you get the right one.
So if there's one piece of advice you take out of this video, if nothing else, apply for the mortgage early. There is no reason, I mean, again, maybe one or two depending on your circumstances, but for most people, there's no reason not to start the process 6 months early. Or the longer you leave it, the more you risk rates increasing further when you could have actually locked something in better around that 6 month mark. So that's the kind of the big one, isn't it?
Yeah.
So I guess once you've taken on board that you want to apply for the mortgage as soon as possible, there's a couple of suggestions you might be able to look at to keep your payments down, or at least keep them lower than what they would have jumped up to. Now, this isn't going to be right for everyone, and there are downsides, but this can potentially help you if you are really concerned about maintaining your mortgage payments on the new higher rate. So I guess the two things that we could potentially look at with a new mortgage application in terms of making amendments are?
You can reduce the term, increase them, reduce them, we'll do the opposite. Increase the term or switching to interest only are both options that will lower your payments, but they do come, as Dan said, with downsides. They aren't a long-term fix, but the idea is that rates are, depending on when you're listening and watching this, rates are kind of abnormally high for this sort of time, and they are potentially a short-term stopgap for a year, a couple of years, something like that, whilst you get on top of finances, whilst things settle, whilst you make plans with them.
Yeah, a couple of points to highlight with those. Number one, as Kai's just touched on, naturally, if you change to an interest-only mortgage where you're just paying the interest, or if you extend the term, you are delaying the time by which your mortgage is fully cleared. So, which will mean that you'll have a mortgage to an older age and you'll potentially pay more interest overall. So we don't like to encourage these options unless you really feel that you have to. So that's the first point. But if you do want to, again, extend the term, that will obviously spread the debt, which means your mortgage payments will come down slightly, but again, you are going to have the mortgage for a much longer period. The second thing is, it will come down to criteria. So extending your mortgage term is generally quite straightforward, providing the mortgage doesn't take you beyond your retirement age. That's when it gets, so if you've already stretched your term right up to retirement, that may not be an option for you. And interest only for a lot of people is actually very difficult to obtain. A lot of the time lenders won't just give you an interest only mortgage unless you've got a very large amount of equity in the property, or unless you have kind of a minimum salary, which is sometimes quite high. So that may not be an option for everyone, but it's something that you can explore.
Yeah, and I think the extending into retirement, it is possible, and retirement age isn't necessarily state retirement age. There's a few variations around retirement. You can sometimes get mortgages to 70 or 75, occasionally beyond. That one is definitely the easier of the two. Interest only is a bit more tricky, but more plausible than maybe it has been for a while. So
potentially.
Yeah.
And then I guess the third way that you can kind of keep your payments down, and we don't want this to we don't want this to necessarily offend anyone, because we appreciate that a lot of people this isn't achievable, but if you have money in the bank which is just sat there not achieving a huge rate of interest, especially relative to the mortgage payment, then actually if you've got nothing else to do with that money, you may decide that now's the time to clear a chunk of your mortgage down. And if you're doing a full remortgage, lenders will allow you to clear kind of an unlimited chunk of your mortgage down. So if you've got 30 grand sat in the bank and your mortgage interest rate is 6.5%, but they're only giving you 1.5% in the bank, then again, that money might be working harder for you if you use that to clear your mortgage. Again, not for everyone, but it is something to consider. And again, your mortgage broker will be able to kind of show you what your mortgage payment will be if you reduce the balance by a certain amount.
Yeah. I suppose then once you've decided how kind of you're structuring your mortgage is when you then go into the next bit, isn't it? So once you realise are you going extending terms, interest only, paying chunks off, once you know what that looks like, you then come to actually picking the mortgage itself, don't you?
Yeah, and so in terms basically what scheme you're going to choose to go on to. So when you first took out the mortgage, the last mortgage, you would have selected the scheme type, whether that's a fixed or a variable, short-term, long-term. So it might be that you're coming to the end of a 5-year fixed scheme, which you took out just shy of 5 years ago. Now, moving forwards, we have to caveat that we cannot tell you exactly which scheme you should go for. We do not know what's going to happen to the market. No one does, and it is very much tailored to you as a client, whether you can afford the new payments, how long you're going to be in the property, your attitude to risk, whether you like to take a bit of a gamble or whether you want the safe bet. So very much tailored to you. But I guess we just want to highlight that some people at the moment are just fixing in for as long as possible because they're basically scared because of how sharply rates have risen. But just bear in mind that if you do fix in for another 5-year fix now, there's a risk that you are moving on to a rate when they are potentially peaking, and with a fixed rate you will generally be tied into that for the full period. So it could be that you're taking out a very high rate and fixing in for 5 years. So if rates did start to come down in the next couple of years, then you wouldn't really be in a position where you can shop around unless you paid quite a hefty arrangement fee to leave the scheme early. So we're not saying you should go for a shorter fix, but we just want you to bear that in mind if you are just have a think about what you're doing before you just commit to a certain type of scheme. On the flip side, I guess for some people, if they just want to know exactly what they're paying and they are concerned about rates going up, I guess they could look at something longer, couldn't they?
Yeah. I think this topic is easily a 10, 15, 20 minute chat on its own.
Yeah.
And we could talk about this for ages. Dan said it will come down to your own circumstances, and part of the conversation with a broker and generally with your bank, if you're talking to them as well, it is trying to figure out what's important to you. So stability of payments, yes or no. Your thoughts or what you might have seen on the market combined with maybe the thoughts of the people you're talking to. What your plans are in the future, your short-term, long-term, your attitudes to risk. There's so many factors that go into taking a variable or a fix, a long-term or a short-term, but ultimately that conversation you want to have in detail. That's the second part of the conversation you have with the broker. The first point is just give them all your information, and then at the end of that conversation it's, right, what do we do?
How do we kind of make the decision together, obviously taking on board what you think and what's important to you, and we can obviously give you guidance on what's happening with the market to make a decision together.
Yeah.
You never know if it's going to be perfect until we look back in hindsight, but we just need to make an informed decision, don't we, based on the information that we have. And obviously we touched on short versus longer fix. Some people believe that actually the base rate may not continue, the Bank of England base rate may not continue to rise by a significant amount. So actually, if you're in a market where tracker rates, so variable rates that follow the base rate, are a fair bit lower than fixed rates, you might decide to go on a tracker, knowing that even if the base rate goes up by another quarter, half, 0.75%, it still would potentially be lower than fixed rate. So again, that's a potential approach. There are obviously risks with that, and you'd have to understand the risks, but they're just a couple of the different options that you might decide to look at. I guess the final thing is, this isn't part of the remortgage, but once you've moved over to the new scheme, and the new scheme has started, there have been some recent regulations, haven't there, where basically the FCA have asked lenders to be more flexible with people to help them maintain their mortgage payments, haven't they?
Yeah, you might have seen a few, depending on when you're watching this or listening to this, a mortgage charter was introduced, which the whole idea is what can it do to help homeowners who are struggling to meet their increased payments. And it's essentially asking the lenders to be more flexible. If you've just taken a new product, it's at 6%, and you're trying to maintain those payments but you're struggling, lenders have to now be a little bit more lenient. So There's a few things. They'll be more lenient by potentially letting you switch to interest only or extending the term, which we've discussed on for new borrowers. But if you are tied into a high rate and struggling, they are meant to be more accepting of that. They'll put you through their own process, but they'll be more accepting than they have been in the past. They'll offer products generally as an existing customer if you are remortgaging a bit earlier, so maybe 6 months now, whereas before it wasn't quite as long. And they'll take longer to repossess is the other kind of key point of that particular piece of regulation. They have promised as much as they can to not repossess until at least 12 months. And if possibly longer if it needs to be. So they're trying to hold off as long as they can and minimise the damage where they can, and that is still regulation that's being built on. So that we're filming in second half of 2023, that could be different as time goes on. But
yeah, the main thing really is if you start your new scheme and you are struggling, as Kai touched on, contact your bank directly and let them know, look, the payments are actually getting to a point where we're not sure we can maintain them, and they should do kind of everything they can to give you the flexibility to try and get on top of things. I guess that's the main thing, isn't it?
Yeah, talk to your bank, don't just sit there in silence.
Yeah. I think that covers everything. Again, we really hope whatever happens that you do manage to kind of, find the best possible deal and manage to maintain your mortgage payments, because we get it is really hard, especially in a cost of living crisis where everything else seems to be going up as well. So we know it's stressful, not the best time if you have a mortgage and your scheme is ending, but if you need any help with the remortgage, you can contact us and we can kind of talk you through the whole process and oversee the mortgage application for you. We'll see you next time. Thanks a lot.